Hello and welcome to our monthly trade floor video. I'm joined today by Portfolio Manager Rob Mead. Rob, let's start with our outlook for Australian and global interest rates. Firstly, will they keep falling? And then how low could they go?
It's a great question, Hugh. And I'm recently back from our cyclical forum in Newport Beach. And the lower for longer theme that PIMCO's talked about for quite a while now is still firmly intact. We are entering a window of weakness, we think, in terms of global economies and how they're growing. It really depends on how long that window lasts in terms of what we start seeing from central banks. The RBA has been very clear, and especially in their recent rate cut to 75 basis points, that they're looking to continue to provide monetary support until we get to full employment and the inflation target. So that was very, very clear that they're still full steam ahead. The market's already expecting another rate cut by February next year, but there's a very high probability that it may even happen before that, especially as the banks aren't passing on the full rate cut in terms of their own mortgage rates. So lots more work potentially there to do, especially in a world where there's not much fiscal support. So expect to see additional monetary easing. Incredibly, we're now talking about potential for quantitative easing in Australia. And many of our viewers probably don't even know what that means, but it essentially just means the central bank needing to try to support the economy even further by literally buying assets, buying bonds, maybe buying other things in order to try to stimulate growth. So a new regime we may be potentially entering into in Australia that some of the other countries have already had to navigate.
In this environment of increased uncertainty or window of weakness that you described, it's important for us to maintain diversification in our portfolios. And for this, we want some selective exposure to high quality fixed rate bonds, or duration as we call it. So where do we prefer to get this exposure around the world today? And why is it important in portfolios?
Yeah, it's another good point. So if you think about where bond yields are priced, I think it's always a good reminder that they're not in some sort of parallel universe. Like every asset class, every asset is affected by the bond yield and the level of interest rate. So the reason some of these risk assets are so elevated is exactly the same reason for yields being so low. So when you think about different markets around the world and their level of defensiveness or the types of duration you'd want to own, US Treasuries stand out because they have the furthest to move. We do think as part of that window of weakness that you mentioned that the US economy is also weakening. Some recent data suggests it's probably weakening faster than some expected. And we think that will realise at least 3 rate cuts from the Federal Reserve over the next 12 months. The market's largely priced for that. So we think in terms of duration, you definitely want to have some in your portfolio. You need to have some defensive assets in a healthy portfolio, diversified portfolio mix. But when you're looking at rate markets around the world, we'd say the US market is the one that has the most to move.
And finally, it's always important for us to be generating income for our clients as well. Where are we finding opportunities to do this, and how can we continue to do so in a low yield world?
Yeah, I think it's really important to think about what to do in a portfolio when the risk-free rate goes below the inflation rate or the inflation target, right? So Australian investors haven't had to deal with that reality. So they've been able to have quite inefficient portfolios and still do okay. They've been able to own cash, which was generating a real return, and a bunch of risky assets at the other end of the barbell. Nowadays, that makes no sense. We need to make sure that investors are thinking about how to invest across the full risk return spectrum, which means allocations to bonds, it means allocation to credit, it means allocation to some sorts of private credit where you can take advantage of some illiquidity premium. So building that diversified portfolio, having some of the defensive assets like US Treasuries still makes sense. Being a little bit cautious in terms of generic credit, so much more focused on bottom-up opportunities. As we've discussed many, many times in the past, we still think the financial sector will do well in almost all environments because of the way that the banks have recapitalized. We also think that some of the structured credit areas, especially those backed by global real estate, US real estate, to some extent Australian real estate, will do well. And then also private credit, where investors have capital that is permanent, that they can lock up for a while to generate some higher returns and some diversification away from some of the other assets in their portfolio. So really thinking about portfolio efficiency, diversification, and capital preservation.
Great. Thanks, Rob. And if you would like any further information, our latest cyclical outlook, Window of Weakness, is available now on the PIMCO website at pimco.com.au. Thank you.